Hi, I'm Greg Pierce, the finance coach, and now we're going to discuss the mathematics of finance for chapters 2 through 12. We'll go through all the problems in chapters 2 through 12 and look at a way of thinking, basically. On each of these problems, I'd like you to write down the words given equation solution, and we'll write down the givens, we'll look at which equations we need to solve these problems, and then we'll look at the solutions. First of all, we want to learn the mathematics of finance, and then be able to type these same formulas into your financial calculator and get the same answer. It's a good way of checking your mathematics. And then finally, we want to be able to key these same formulas into Excel and again get the same answer. So first of all, learn the mathematics. Second, learn how to plug it into your financial calculator. And third, learn how to plug it into Excel. Chapter 2, Problem 1. Penguin Pucks has current assets of $4,800, net fixed assets of $27,500, current liabilities of $4,200, and long-term debt of $10,500. The equations we're going to use are assets equal liabilities plus owner's equity, and net working capital equals current assets minus current liabilities. And we just need to plug the numbers into a balance sheet that I've constructed already vertically. So we see from above our current assets are $4,800. Our net fixed assets are $27,500 for a total of $32,300. And we know that our liabilities plus owner's equity have to equal our total assets. It's got to be. So we fill in the $32,300 and we need to balance the balance sheet. We plug in our current liabilities of $4,200. We plug in our long-term debt of $10,500. And then simply find the difference to get our owner's equity, which we're looking for. And in this case, our owner's equity is $17,600. They also want us to find our net working capital, which is $4,800 of current assets minus $4,200 of current liabilities. And we get an answer on this one of $600. And that is how we work problem number 1. In problem number 2, we have Billy's Exterminators has sales of $734,000, cost of $315,000, depreciation of $48,000, interest expense of $35,000, and tax rate of 35%. And the question is, find the net income, or NPAT. The formula we're going to use, the equation is sales minus cost equals net income, the basic income statement equation. And we start filling in the holes again. So sales, we plug in $734,000. Cost, we plug in $315,000. Depreciation, $48,000. And we come up with an EBIT of $371,000. From that, we subtract interest expense of $35,000, so we get $336,000 for EBT. And from that, we have to calculate our taxes. So our taxes, we take 35% of $336,000, and we get $117,600 of taxes. We subtract those two numbers to come up with NPAT of $218,400. And that concludes problem number 2. In problem number 3, we have Billy's Exterminators paying $85,000 in cash dividends. What are the additions to retained earnings? Equation is additions to retained earnings equal to your total net income from the last problem minus dividends paid. So we take $218,400 from problem number 2 minus $85,000 in dividends paid, and we get an answer of $133,400. And that concludes problem number 3. Problem number 4, we are given that Billy's has 110,000 shares outstanding. What is Billy's EPS and DPS, or earnings per share and dividend per share? So to calculate EPS, the equation is net income over shares outstanding, or I use the abbreviation NPAT, net profit after tax, same thing as net income. And to calculate dividends per share, I take dividends paid over shares outstanding. So for their earnings per share, you get the net income of $218,400 divided by 110,000 shares outstanding, and you get an answer of $1.98.5. 1.985. And for their dividends per share, you take $85,000 in dividends paid divided by 110,000 shares, and you get an answer of 0.7727 cents per share. Let's put our units in there. Per share. Again, carrying these out to 4 decimal places. In problem number 5, we have Klingon Widgets purchasing new cloaking machinery 3 years ago for $6 million. This is the gross book value when we first put it on the book, so it's not of any consequence to this problem. Machinery could be sold today or liquidated for $5.3 million. That's on the market. The net fixed assets on the balance sheet is $3.2 million, so the $6 million has depreciated down to $3.2 million in 3 years. So I take their gross fixed assets minus accumulated depreciation, and I get $3.2 million today. Current liabilities is $900,000, net working capital $215,000. Current assets could be sold for $1.25 million. What is the book value of the total assets and what is the market value? So we need to create a little balance sheet vertically with 2 columns, book value and market value. Book value is what's on the books, market value is what we could sell these assets for out in the market. First of all, to calculate the current assets, because they're not given, the equation is total assets is current assets plus net fixed assets. The problem is we were not given current assets, so we must calculate them first. We were given net working capital, which we know is current assets minus current liabilities, so we can use the net working capital number to calculate the current assets. So first step, I take my net working capital of $215,000 in the givens, and that's equal to current assets minus $900,000 of current liabilities. Move the $900,000 to the other side, and I calculate my current assets are worth $1.115 million, 1115000. I can then use that and put that number into the book value of the current assets. So my current assets are 1115000 as just calculated because it was not given. The net fixed assets on the books are worth $3.2 million. It says net fixed assets on the balance sheet, $3.2 million. So I plug that in, and I get a total book value of $4315000. That's the answer to the book value column, 4315000. And then I want to calculate the market value. So given was we could liquidate the current assets for $1.25 million, or sell the current assets, turn them into cash for $1.25 million. I could sell the property, plant, and equipment for $5.3 million, add those 2 pieces together, and I get my market value, and that is $6,550,000. So there, your answer is the book value on the books, 4315000, and the market value is 6550000. That concludes problem number 5. In problem number 6, Amber Lynn Company had $255,000 in 2011 taxable income. What are the income taxes in 2011? So to calculate this, we have to step down through the tax brackets and calculate the taxable income. There's a table in the book that gives you the tax percentages to apply to each level of income. So for the first $50,000 of income of that 255, we're going to tax it at a 15% rate, or $7,500. The next 25%, next 25,000, are going to be taxed at 25%, or $6,250. The next $25,000 are going to be taxed at 34%, or $8,500. And the next $155,000, which takes into account all of our $255,000 of taxable income, the next $155,000 is taxed at 35%, or $60,450. Add all of these up, and I get our total tax bill or tax liability of $82,700. And that is the answer to problem number 6. In problem number 6, what is the average tax rate and what is the marginal tax rate? That's what we're looking for in problem number 7. To calculate the average tax rate, we know it's the total tax bill divided by taxable income, and the marginal tax rate is the tax I would incur on $1 more of taxable income. So to get the average tax rate using problem number 6, I take the total tax bill of $82,700 divided by the taxable income of $255,000, and I get 32.43% on average. It's my average tax rate. And then what is my marginal tax rate? Well, I have to ask the question, what if I made $1 more of taxable income? If I had $255,001 of total taxable income, so that $1 will be taxed at 39%. Because that was our last tax rate and we hadn't used all that eligibility up there. So the answers are 32.43 for the average tax rate and 39% for the marginal tax rate. That concludes problem number 7. In problem number 8, we are given that Chevelle has sales of $39,500, cost of $18,400, depreciation expense of $1,900, interest expense of $1,400. The tax rate for this company is 35%. Find the OCF or operating cash flow. We know that one of the 4 ways we can calculate OCF is EBIT plus D minus T. To find these numbers, we need to build a vertical income statement. So whenever you see the letters OCF, always build a vertical income statement. And I've done that. So we bring our sales in of $39,500, our cost of $18,400, our depreciation expense is $1,900, giving us earnings before interest and taxes of $19,200. From this, I subtract the interest expense of $1,400, and I get EBT, or earnings before taxes, or profit before taxes, $17,800. From this, I take taxes out of 35%. Because their tax rate is given at 35%, I get a tax bill of $6,230, leaving me with net income of $11,570. Swoosh, swoosh. So I build my vertical income statement, and that gives me the 3 pieces I need for my OCF calculation. OCF is EBIT of $19,200 plus depreciation. I must add it back because I subtracted it out, and depreciation is a non-cash expense. So when I want to calculate operating cash flow, I need to add back the depreciation of $1,900. From this, I subtract the taxes that I paid out in cash of $6,230, and my final answer for OCF is $14,870. That concludes problem number 8. In problem number 9, we have Earnhardt Driving School with 2010 net fixed assets of $2.8 million and 2011 net fixed assets of $3.6 million. Depreciation expense is $345,000. What is their net capital spending? That is what's given. The equation is net capital spending equals ending net fixed assets minus beginning net fixed assets, and then we gross them up using depreciation. The other way to calculate this, if these numbers were given, will be ending gross fixed assets minus beginning gross fixed, but since the author doesn't give us that, we must gross them up using this formula. So I take my ending net fixed assets of $3.6 million, ending being the later year of 2011. Beginning, we started the year with $2.8 million in net fixed assets, and we had depreciation in the year, depreciation expense of $345,000, which I must add back. Therefore, my net capital spending in 2011 is $1,145,000. 1145000 is the answer to problem number 9. Number 10, we have Greystone with current assets in 2010 of $3,120, current liabilities in 2010 of $1,570. In 2011, they had current assets of $3,460 and current liabilities in 2011 of $1,980. What is their change in net working capital? So equations, change in net working capital is ending net working capital minus beginning net working capital. So I have to determine which year is which, and then just calculate my net working capital, which we learned very early is current assets minus current liabilities. So the ending net working capital is the 2011 net working capital, and that is 3460, and less the current liabilities 1980. So I get a ending net working capital of $1,480 for Greystone. Beginning net working capital is 2010. I take their 3120 of current assets minus their 1570 of current liabilities, and I get a change in beginning net working capital of 1550. Now I want to see the change between the 2 years, so I take the 2011 ending net working capital minus the 2010 beginning net working capital, 1480 minus 1550, and I get an answer of minus $70. Their change in net working capital is minus $70. That's the answer to problem number 10. Problem number 11, we have Maria's tennis shop with long-term debt in 2010 of $2.3 million, long-term debt in 2011 of $2.55 million, so they borrowed some money. Interest expense in 2011 was $190,000 paid out. What is their cash flow to creditors? We're going to use this answer in problem number 13, so save it in our calculation of CFFA. The equation for CFTC, first order of business, is interest paid minus net new borrowing. I have to look at how much they borrowed over the year. And net new borrowing is ending long-term debt, $2.55 million minus beginning long-term debt of $2.3 million. So the first thing I do is calculate that net new borrowing, $2.55 million minus $2.300 million, and I've borrowed an additional $250,000. Interest paid is $190,000. That was given. So what is their cash flow to creditors? Interest paid minus net new borrowing. I get an answer of negative $60,000. And remember, save that answer. We're going to use it in problem number 13. So the answer to problem number 11, CFTC, is negative $60,000. Problem number 12, we have Maria's tennis shop, which has 2010 common stock of $680,000, 2010 paid in surplus of $4.3 million. In 2011, their common stock went up to $715,000, and their paid in surplus went up to $4.7 million. During the year, Maria's tennis shop paid out dividends of $540,000. And the question is, what is their cash flow to stockholders? Again, save this answer when we're finished so that we may use it in problem number 13. First of all, I want to calculate the net new equity raised, because CFTS, cash flow to stockholders, is equal to dividends paid out minus net new equity raised. So first, let's calculate net new equity raised. I take the 2010 common stock plus paid in surplus. Those are two accounts in the equity account that I need to add up to get the 2010 total. And I take $680,000 of common stock and $4.3 million of paid in surplus, and I get a total equity number of $498,000. 2011, I take my $715,000 of common stock and add that to my $4.7 million of paid in surplus for a total equity balance of $5415000. I want to calculate my net new equity raised by taking the delta between the two. So I take my 5415 of 2011 minus 4980 for 2010. I get a delta net new equity raised of $435,000. Then I subtract that from my dividends paid of $540,000. So my cash flow to stockholders is dividends paid $540,000 minus net new equity raised $435,000, and I get an answer of CFTS of $105,000. So if you got that on problem number 12, good job. You want to save this answer because we're going to calculate CFFA in problem number 13, which is CFTC from the problem number 11 plus CFTS in problem number 12. That concludes problem number 12. Problem number 13, once again, Maria's tennis shop has 2011 net capital spending of $1.3 million. This means they spent $1.3 million on property, plant, and equipment. They reduced their net working capital by $55,000. Key is here the negative $55,000. They want to know what is their 2011 operating cash flow. So we're going to use problems number 11 and 12 to solve problem number 13. The equations are as follows. Cash flow from assets is CFTC, which we calculated in problem number 11, plus CFTS, which we calculate in problem number 12. Also, CFFA is also equal to OCF minus NCS minus CNWC, another way of calculating CFFA that will allow us to isolate and calculate OCF, which is the question we have at hand. So first of all, I want to calculate the first part, CFFA, which is CFT, C from problem number 11, negative $60,000 plus $105,000 from problem number 12. And if I add those two numbers together, I get cash flow from assets of $45,000. Then I plug that into this equation and also plug in the given net capital spending and change in net working capital. So my $45,000 of CFFA is equal to OCF minus net capital spending of $1.3 million, minus a reduction in net working capital of $55,000. And this allows me to solve for my OCF. Therefore, OCF is 1290000. And that concludes problem number 13.